Hi everyone, my name is Callahan, and today we're going to talk about real estate market research and why it should matter to you. Real estate market research is about knowing what you don't know. Because in real estate, what you don't know will hurt you. Whether that's a faulty foundation, broken pipes, those things can hurt you and cost you money, but they're controllable. Either you fix them or you don't. However, things like a declining population, poor appreciation, high crime area, low performing schools, those things can affect the success of your real estate property, and those things you can't control. They're the conditions of the market. So if you're going to buy somewhere and try to make money with real estate, buying the right location is critical to the success of your investing strategy, because those are things that can make or break you that you can't control. So what makes a good location in real estate? There are a couple of key things that we'll look at today, including our market recap. A recap stands for rent, employment, crime, appreciation, population. At the bare minimum, always do a market recap before you buy somewhere. And if you want to be extra confident in your property's location, stick around, I'll tell you a little bit more at the end of the video. So first off, rent. Rent is important because you need to know that the rents you're charging are going to cover your principal, interest, taxes, insurance, utilities, landscaping, maintenance, vacancy, and other unforeseen costs or the planned costs like property management. If your rent is below those numbers combined, you are losing money month to month. And for you, maybe that's okay. Maybe you're making an appreciation play. But if you need cash flow in your property, and especially if you're doing something like a short-term rental or rental arbitrage, your entire business model is based upon being able to rent for more than your costs, and your main objective is cash flow. So looking in the 1 to 3 mile radius for rent comparables that are near the property that you're buying as far as location, but also near as in terms of like-mindedness, in the sense that a 2-bedroom, 1-bath nearby is renting for $1,000, then your 2-bedroom, 1-bath should also rent for about $1,000 if the finishes are the same. You have to know what things are renting for in your market, and not just 10 miles away, but as close as possible to your rental property. Second is employment. If I'm buying in a town that's an oil boom and bust town, and for 2 quarters of the year, oil is running real well, $100 plus a barrel, and the job market's booming, that's great. High demand for people coming into the labor market means a lot of people need housing. That means I can make money. But if oil goes down and I'm in an oil market, and most of my renters are blue collar who are in the oil and petroleum industry, when oil barrels go down to $30 a barrel, they leave to go find work, and now my vacancy is through the roof. So when I'm buying somewhere, I want to know that I'm buying in an area that has strong and stable employers in industries such as government, education, healthcare, professional business services. All of those things can provide stable income to my renter population, making sure that when I rent to someone who's working in those industries, I'm not going to get hit with a phone call 6 months in saying, hey, job dried up, I got to get out of my lease early and leave. Third is crime. This one's pretty simple, guys. No one wants to live in a war zone, so you probably don't want to buy in a war zone. Buying in a high crime area can lead to lower occupancy as people are afraid to rent there, higher property damage, at risk of violent crime, and having difficulty competing for other people who are willing to live in a high crime area, and that usually comes along with lower rents. Buying in a high crime area is generally never a good idea unless you're going to be spending millions of dollars of buying an entire neighborhood's worth of properties, systematically renovating every single one, hiring your own security force to basically completely turn around an entire neighborhood. And if that's you, good for you, and that's fantastic. I want to see you succeed. But if you're not planning to buy an entire neighborhood at the same time and systematically turn the whole place around, try and avoid high crime areas so that you can have a property that holds its value and you're not spending thousands of dollars and trying to fix when something or someone decides that your property needs a little more paint or graffiti than it normally does. Fourth is appreciation. In real estate, you have forced and natural appreciation. Forced are things that you can control. That's things like the roof, the flooring, the paint, the appliances, the counters, anything you can swing a hammer at or hang up and improve the property's value. That's what you can control, and that will increase the property's value, making more money. Natural appreciation are things you can't control. So that is the desirability and the demand for the product in your location. Perhaps your property's location is near some high-ranking schools or some businesses or employers, or it's just in an area that people want to move to. When a lot of people want to move to the area around your rental property, rents go up and property value go up over time. So if I'm buying somewhere and I have an option to buy in a zip code that appreciates at 2% per year, or another zip code that appreciates at 10% per year, every single year that I'm holding a property in the 2% area as opposed to 10% area, I'm losing tens of thousands of dollars in lower net worth and lower property value. So buying somewhere where the forced appreciation will improve your property's value, but where also the natural market appreciation is working with you and not against you, will make your success compound on top of each other and provide a much easier and more lucrative exit when you go to sell that property. Last is population. We are business owners. We provide a product that is rental housing units. Or if you're a flipper, you're selling houses to people. By and large, we need people in order to buy our product. And if people are leaving, if they're emigrating out, or if your location is causing people to move away, less people need your product, which means there's less demand, which means to attract the current demand or lessening demand, you'll have to lower prices and fight harder for a smaller pool of renters or home buyers. Buying somewhere that has an increasing or growing population gives you the opportunity to increase prices because there's increased demand, as well as have to fight less hard to attract people to your product because people already want to be there. So those 5 things in your market recap, your rents, employment, crime, appreciation, and population, are all natural market drivers that you need to know before you buy a property because they can and will affect your property's success. Now, additional factors you can look at to be extra confident about your location are things like school rankings. Typically, if you're renting to young families, say 3-bedroom, 2-bath houses where it's a young couple and a couple of kids, things of that nature, or you're selling property to families, one of the number one things they cite as far as property's location is school district and where the schools and how the schools are performing nearby. So the closer you can get to a high-ranking school, you can know that your renters and home buyers are looking at that too, and that by proxy makes your property more valuable. Second, local businesses. If I'm a renter, I want to be near a gym, a grocery store, a healthcare, a pharmacy, parks. The closer you can be to local amenities, including things like shopping districts and entertainment areas, the more attractive that property is, the more likely you are to have more demand. Third, rental unit vacancy. On a market basis, is that market experiencing higher than average vacancy rates in the 10 to 15% range? Or is rental vacancy really low, maybe in the 2 to 5%? That can showcase demand for the area and also reflect an increasing desire for people to move there and is likely indicative of a lot of demand for your rental housing products, meaning buying there is probably a pretty good bet. Fourth, unemployment rates. Are people experiencing a wave of unemployment? Are you going to have difficulty finding someone that can afford to move in? Or is unemployment really low in your market and you're finding that everyone is making a ton of money, everyone is employed, and you're not going to have difficulties whatsoever in actually renting that property out. Lastly, build permits and path of progress. This is a big one, guys. If I'm buying a property and I'm buying somewhere that shows the development is going westward, which means that more companies are buying property, developing it, new office, retail spaces are going up, and by and large, new homes are going up to say in the westward direction. That means if I buy there, I can buy low, ride the wave of development that comes along with westward expansion in that particular scenario, and sell high when the area's been developed around me. By buying outside of the path of progress, you can be buying somewhere where the city's no longer incentivizing investment via tax credits, and the area could be declining, which is why the city is developing the other direction. So if you're buying somewhere and you have the option of buying in the path of progress or away from the path of progress, you want to be buying where the other people are pouring their money into developing, and in the path of progress will make you money by proxy. Thanks for listening, guys. All those things would help summarize why real estate market research should matter to you and why location is the golden rule of real estate. You want to control everything you can when it comes to real estate, and the things you can't control, you want to be in the know of so that you can use them to your benefit and not to your detriment. Thanks for listening, and happy investing.